Okay, welcome everyone. We'll start our lesson 1, which is about LO1. Today lesson will go through learning outcome 1, understand the key financial theories. My name is Anjum Sattar and my email address here. Good afternoon, or we say good evening now. So today we are going to start a new unit, which is the financial management. Financial, of course, we understand with the word, which deal with the money, with the finances. And what is the management? What we know about management? Anyone? What do you think? What we know about management? What is the management? Yes? Yes, please. What do you think? What is the, how you can define in your own words, what is the management? What do you think?
I can't remember now. I can't explain.
No, you can't explain. No problem. Management, we learn about maybe planning, yes, in one of ACC as well, yes. Management
Yes.
is control. Management is organizing, yes.
Yes.
The implementation, yes. So these are all management functions. These are the functions.
Okay.
Management. But if you're a manager, yes, your job to plan, yes. So you do all these your roles. Okay. So management definition, we can say management is a process of designing an environment to achieve pre-selected objective. Okay, that's why we need management.
Okay.
If you're a manager, you have to design environment, whatever objective you have. You can manage whatever you want. In night shift to put staff, day shift, yes. You want to spend more money on training, you want to, it's up to you. You are a manager, you've been given the resources. But end of the day, objective we have. At the end, you have to achieve something, yes. Like your objective today to do this course, to achieve this qualification, OTHM level 5, yes. And your further objective can be you become accountant. Your maybe further objective to set your own business, yes, become your own boss. Maybe these are all your objectives. Some can be short term, some can be long term, yes.
Okay.
Objective always, when we set objective need to be smart. Do we know what it stands for smart?
I don't forget now.
Objective needs specific, measurable,
okay,
achievable, realistic, and time bound, yes.
Time. Yes, I am.
So if somebody say, I'll bring the star for you, is it smart objective? They can bring the star. Or I will become billionaire in next year. Is it smart objective? Because
no,
it's not really. We need to think about, I will finish my PhD in 1 year. Is it smart objective?
Yes.
It's very difficult to finish PhD in 1 year, yes? Because minimum is a requirement 3 years, yes?
I don't understand what's meaning PhD.
You want to be a doctor in accounting.
Okay.
Last year of doctorate, yes?
Yes. Understand.
So, not a smart objective. You can't do it, yes? If we are earning 1,000 and we'll say, I want to become a billionaire in next month. So maybe anything is very ununique will happen, can be, but otherwise it's not, yes? It's not a smart objective. Okay. So that's, we need to be look around. So financial management is all about the money we have, we need to be managed. Yes?
Okay.
And we need to achieve our objective. Because we can't say even as an individual, I have unlimited resources. I have a limit on my money. I have to find the option, which one is the more important, which one is the less important, yes? So I will allocate my resources accordingly. That will go through in detail. Huh? Okay, that's a bit, little bit introduction about the unit itself, and I'll show you. Okay, can you see? This is the unit we have. This is the unit aspect which we're supposed to be learning. We're doing financial management, which is a level 5 course.
Okay.
So this is a level 5. This is a 20 credit unit. Normally it need to be spent time around. Yes, it's not mean you will deliver in so many hours, but it mean you spend time to learn it. It's a mandatory compulsory unit. This is a part of accounting and finance in business, and the grade will be pass or fail, not merit, not distinction, nothing. Only pass or fail. The aim of this unit is to provide learner with the knowledge about the key financial theories, yes, which we will go through.
Okay.
And the working capital, how we manage our cash, working capital, our people, our resources, the review technique, and we achieve the organization goals, and we'll minimize our financial risk. Risk is always we have in business, yes. So we have 3 learning outcomes. So we'll do in 3 lessons. Today lesson we'll go through evaluate the financial theory, and we'll assess the strategic implementation techniques, which we'll go through. Yes. Today lesson that will be discussion, and then the second lesson will be understanding about the working capital. Third lesson will be about risk, global risk. Yes, throughout the world, what risk we have when we invest the money. Okay. So today lesson we have outcome 1, and these all the theories we supposed to learn. This is these are called financial theories. How we manage the funds. We need to make a decision either to invest or not. One is first theory, we have a arbitrage pricing theory. Then we have a rational choice theory. Then we have a prospect theory. Then we have a cumulative prospect theory. We have Monte Carlo option model. We have binomial optional pricing model. We have a Gordon model, and we have an international Fisher effect. So these are all the theories, yes. So we'll go through basic understanding about these theories according to level 5. Maybe we need a little bit explore our own background research, which I'll copy the link for you to further reading. Okay, then we'll go through portfolio, all these, and strategic management. So these are the inductive content, these words we're supposed to be covered. Then lesson 2, we'll go through these, and then lesson 3. So this is inductive content. We've been given the recommended books, yes. We've been given what we're supposed to do. We're supposed to do the coursework, yes, learning outcome 1, which I'll show you and we'll complete, and we're supposed to be write the report, yes. So this is all. When we'll do this, we'll pass this unit. Okay, so next now we'll start our welcome. Okay, what is your current knowledge about pricing theory? What do you think, 1 to 10, where you can rate yourself? Which scale? If somebody say scale 1 to 10, where you are in terms of the knowledge about pricing or financial management?
5.
5. Okay, so we are on 5. So we'll see how much we'll move this side then, Yeah.
Okay.
We have time. So this is what I said is the inductive contents. This is what we have, the assessment criteria. Yes, what we're supposed to. And we have command word is evaluate and assess. We have assess, strategic implementation techniques. Okay, so first theory, we're looking what is the financial management. So what is financial management? As I earlier mentioned, financial management is concerned about the efficient acquisition. It means you acquire, and deploy, it means use of both short term, which is 1 year, and the long term financial resources, long term more than a year, to ensure that the objective of enterprise are achieved, objective of organization can be achieved. So what we need to do, we need to be make CN and decision making taken in 3 areas. We need to make the decision where to invest. Either we buy the non-current asset. Do we know what is meant by non-current asset? Or we know asset? What is meant by asset?
Yes. I know.
So asset mean anything you?
What?
Anything? Asset mean anything you own it. Yes, anything
Okay.
which show the future economics benefit is called asset to your business.
Mm-hmm.
And like building, plant, machinery, these are non-current asset. Yes.
Okay.
And the current asset mean the cash, prepaid, and account receivable and inventory. These are the current asset, which is short-term asset. Current means short-term, non-current means long-term, which we can use more than a year. Okay, which we'll go through.
All right.
Finance mean borrowing money. Yes, where we can get the money from. Dividend mean we should pay the dividend. Yes, cash, return on investment to shareholders. So this is all about which we supposed to go through. That's it. Financial management deals. Financial management decision makes either to invest, where to borrow, and how much dividend we pay. Okay, then we have a first theory, which is arbitrage pricing theory. It is a multi-factor asset pricing. Multi-factor, yes, there are various factors we look based on the idea the asset return can be predict. Yes, what we can do, asset return, we can predict how much return will be using the linear. We learn in math, linear mean relationship. Yes, like think about, like when we say, when we have a hot weather, what happen? Ice cream, it will be more sale, less sales.
What?
Ice cream, more people will eat
Yes.
ice cream when we have a hot weather. Yes.
Yes.
So we can say there is a relationship between the weather and ice cream sales. Yes, that's the linear.
Okay.
Linear means, so like, when we have a cold weather, then the more sales are, we can say maybe eggs. Yes, maybe different food, those keep us, especially
All right.
dry fruits and things. So there is a relationship between weathers. So expected return and number of microeconomic variable. Microeconomic variable means to learn about, do we know the past? Political,
Yes.
economics, yes, social,
Yes.
and technological factor. Yes.
Yes.
So these we need to be these are called microeconomics variables. Is capture systematic risk. So these can bring the risk for the business. Yes.
All right.
So like more people buying now online. Yes. We have in the UK WH Smith. They sell books. Is it a lot of people buy hard copies? Is very few people buying books now. More are people reading online. Yes.
Yes.
So that's why so this is technology change. So risk for W.F. Smith, maybe less people will buy the books. They have they close a lot of stores. Huh?
Okay.
So we need to be in a business, we need to understand this. It is a useful tool to analyze the portfolio. Portfolio means, you know, we heard about don't put all your egg in one basket. Yes? Don't put all your egg in one basket, because maybe basket will fall down and all eggs will be.
Yes.
So one company, we have a Bitcoin, which is very high. So in 2012, their one share was $12. Yes. Do you know how much is now Bitcoin?
No.
It is now $27,000. Yes.
Okay.
So think, if somebody bought $12, yes, and now they are owner of $27,000. It's a huge.
Okay.
So, but if we'll put the money, all investment in, maybe they will be high risk, yes.
Yes.
So they can be come back again $12. Never know, huh?
No. Yes.
So this is very risky. So we say you investment in different companies. You can say in oil, yes.
All right.
In technology, in we say Apple, yes.
Okay.
Some money maybe you invest in manufacturing, DFS sofas, yes. So your investment in three different, or you can say pharmaceutical, medicine, because the COVID-19, they earn money, yes, their share will go up and we can earn a lot as well out of it, yes.
Yeah.
So that's why divest. So investment in different portfolio, not in one basket, huh? So you can earn more money. Yes.
Okay.
So you need to find which options are the best. Okay, we use the formula. Yes. Please don't need to be. We're not really going to use these, huh? But at least we have a basic understanding. Yes, because sometimes, you know, these math terms look like, oh my god, yeah. So we don't need to too much stress. ER, it represents expected return on asset, how much we expect, yes. R is the risk-free rate, yes. B represent the beta sensitivity risk factor and risk premium. If you have a high risk, you should have a high return. Yes.
Okay.
If your money invested in shares is a high risk, high return. Then in this theory, how the arbitrage theory works? This theory was arbitrage pricing was developed by the economist Stephen Ross. Yes. So in 1970 is an alternative to capital asset pricing model, which is we use. I'm not sure you learn in F3. Yes. It's called capital asset pricing model, which we use in the financial management. And in F9 paper especially, yeah? Unlikely the capital asset pricing model, they assume the market are the perfect efficient. We learn about maybe in economics perfect market. Perfect means any company can in and out. There is a no restriction. Anybody can invest, anybody can leave. Yes, this is called perfect. Assume the market sometime misprice the security. Yes, and before the market eventually correct and security move back to the fair value. Fair value mean market value. So using APT, this approach, yes, hope take advantage of the deviation. Deviation means change, yes, in the market value. So risk, not a risk-free option in the classical sense, because the investor assume the model is correct and making directional trade rather than the locking into the risk-free. Yes, if you deposit money in the bank and you get the interest, is it bank will give you a fix? Yes, there is a no risk. But if you invest in security in shares, Your shares can be from $12 to $27,000 or from $12 to 12 pence. Yes. So that varies. This theory is telling us what is the APT is a more flexible compared to the capital asset pricing model. So we're comparing two theories. Yes. And for this theory, what we need to keep in mind gross domestic product. We run maybe GNP and GDP. GDP means gross domestic product, national income, which is consist of market index, exchange rate, and various trading with other countries. That's our national income. So this always we need to keep when we calculate these. Arbitrage pricing theory is a multi-factor. It's not on one factor. Yes, we discuss pest, we discuss about various other factors. They have a linear relationship with the economics. If economy will grow, they will grow. Capital asset pricing are the perfect efficient. And this theory assumes that the market sometimes misprice security. They not show what is the real value of the stock securities. So that is sometimes misled us, not give the right information. So we need to be very careful. We've been given here example. Can we see here? We can use the formula which we use. So gross domestic product, GDP growth rate is beta is a risk factor 0.6. Retail price is a 4%. This will grow on the retail price. Inflation rate in the country is 0.8 beta, and the retail price is 2%. There is a price will go up. Gold prices is a risk of 0.7, and the retail price will go up by 5%. Standard and the Proof 500 index, the security price index, beta is 1.3 and retail price is 9. Risk-free rate is a 3%. There is a no risk if you can earn up to 3% without any risk. Yeah. If you want more, your risk will be higher. So expected return can be 3% is a risk-free. Then we looking all the inflation factors. We multiplying. Yes, we using the formula which we discussed in the previous slide, and then we come up. If all these risk factors will say under this theory is saying our return can be maximum 15.2%. Any question here?
No. Please.
Okay. So that was the first theory. The second theory is the rational theory. Rational choices. Rational is behind not, the someone bring the star or someone do this and that without any. Yes. We're asking where, sometimes some leaders say, oh, I will do this. But the people say where the money will come from. Yes. Do you have a money? This is the rational. Yes. If you don't have a money, you can't do the things. So rational choice is outcome of your own personal objective. The result is also associated with the individual best interest. Using rational theory is expected the result of the outcome that provide the people with the greater benefit and the satisfaction and the choices. If you give the rational to the people, that will be more satisfied. Yes. And they buy your stock. So many mainstream economics exemption theory is based on the rational choices. Rational choices often discussed associated with the concept of rational actors, rationality exemption, self-interest, and invisible. Rational theory is based on exemption, involvement, rational actors. Economy, rational actors form the basis of the rational choice theories, and they use, because think about big countries, they can change the prices. Yes, they can manipulate the thing. We have to accept it because they are rich. They can manipulate, actively maximize their advantages in any situation. Therefore, consistently trying to minimize their losses. Yes, as a rationalist, you try to minimize your loss. So economists use the rationality exemption in the broad study, understand the certain behavior of society, what the society want, what the people look, which security they look. Yes, why they are going, and what is the rationale behind that. Why you invest in the Bitcoin? They don't have any gold reserve. They don't have any real currency. Why you invest is electronic currency? Yes, it can go, no doubt it's been
Mhm.
gone to 27, but I buy 27,000 pound one coin. In the next minute, that can be £2. And if the company dissolve, I don't have anything. Why I invest in Amazon? What Amazon is doing? Do we know what Amazon business?
Yes, sir.
They're selling online, yes?
Mhm. Mhm.
They have only 12 warehouse in UK, yes?
Okay.
And they don't have anything else. They don't have any properties even, yes? Except these. If I'll buy and invest in that company and tomorrow they close the business or their website down, hack, yes? What will be happen my investment, which I invested in shares, yes?
Okay.
I will lose, yes? So I have to
Mhm.
accept it. This is a high risk, yes? Rational. But other hand, I have to accept what is happening online business due to the COVID. What happened online? We are buying more online, yes? So their business is increased by around 300% during this period. But it does not mean this will stay forever, yes? So we have to be accept the rational behind. So rational theory state the individual rely on the rational calculations, rational choices and outcome. Rational theory is often associated with the concept of rational actor, and many economists believe the rational theory is beneficial for the economies as a whole. So in our assignment, we can write about what is the rational theory, yes? And I copy the link if you want to add some more examples. Huh?
Okay.
Any questions?
No. Yes.
Okay. Then we have next theory we are looking. Next theory is given by one of, we have some here example as well, rational, so I skip it. Okay, we went to binomial. Okay. Then we have a next theory. We done this is the rational. Then next theory we have a prospect theory. Yeah?
Nice.
So prospect theory, as the word indicate, what the future prospect will be. Huh? What gain you will get different individual. So that decision we need to be known as loss aversion theory as well. This concept is the two choices put before an individual, both equal, and one presented the term of potential gain and other the term of possible loss. Yes. So prospect theory belongs, some can be like, credit crunch or whenever happen. Some people gain more, some people lost. Yes. Is it right? Yes.
Mhm.
So if the oil prices will go up, so people look maybe more using the gas cars or CNGs, yes, or move to more electric. Yes. So there is, so
Oh.
who's going to be, oil company will lose, other company will gain. So the one prospect, other loss. So this theory is saying, so is a 50-50, some gain, some loss. Huh? So the losses cause of the greater emotional impact. What will happen? People will be very emotional, yes, an emotional effect, and that can be, if the lost people are very emotional, they can maybe not invest it. Yes, if few people lost, that can impact other people's emotion. So for example, assume end result receiving $25. One option is being given the state $25 and other option is gaining $50. So which one you will go? If somebody say I'll give you $25 now, and somebody say you wait 3 years, you will get $25. Yes. So
Mhm.
you need to be look around. Maybe for time being you losing 25, but you can gaining in the long run 25. Yes. Same both
Oh.
options. However, the individual most likely choose to receive state cash because the single gain is generally observed as a much favorable, and initially having more cash and then suffering the loss. Any question here? Okay, I copied the link under each slide. Huh? Okay, then we have a theory cumulative. Cumulative means total. Yes, we learn in math. Cumulative factor total. Yes, this model is descriptive decision under the risk and certainty. Normally in business we use the word higher the risk, higher the reward. Think about those countries have a high inflation. Maybe we can say in Libya now. Yes. So high prices going up. So, but there is a more option as well. People can earn more money as well in certain profession. Yes. So they can accumulate more. They can earn more as well. Yes. So this theory is guide us how we can accumulate our wealth and what are the aspect of the. So this teaches how we can do it. Any question on this one?
No, it's clear.
Okay. Then Monte Carlo method. The guy was the Monte Carlo gave this option. This option is a mathematical equation. Like we learn in stats, least square method in maths. Yes. Y is equal to a plus bx. Yes. So they're saying there can be if one factor, so there are the least relationship. But the secondly, the state valued for every time step. The value option is calculated by moving through the step. If your time steps more, your times is more, your value will be more. Yeah. State by making the optimal decision. Optimal mean based on the rational decisions. Yeah. And the second step can be done with the multiple price path and stochastic effect procedures. Like if you do this, it will be chain this. Like if you inject money 10% in the economy, this is called Phillips curve effect in economics. So that can be generate 2,000 rupees or whatever we can, whichever currency we can say. Yeah. So if you inject £5 in the economy, you can make it £40 out of it. Yes. Why? Because if it goes in one person generate more, other person will generate more, third person will generate carry on earning as the economy will be generate more. Does it make sense? Like you manufacture things, you sell it, other person keep the profit, other person sell to others. Yes. So everyone is earning, everyone is multiplying and paying taxes, and the government is gaining as well. Okay. Any question?
No.
Okay. Then we have a binomial option. We'll learn about maybe in probability, binomial probability. Probability means the chance of occurrence. So this model is agreed to accumulate price of any tradable asset. Its challenges why the stock price is constantly changed. In reality, company hardly change their valuation. Company not change the price. Who change the price? People. Why people change the price? Because when people buy that stake more and more and demand, so one is buying from other, then the companies carry on selling more shares in the market. The company keep the same price on the face of the shares, but the people can manipulate it because due to the high demand of the thing. The difficulty in reaching a consensus of the correct pricing any tradable asset leads to the short-lived arbitrage opportunity. So, but lot of successful investing boil down the simply question present day valuation. What is the right current price today is expected future. Yes, the future will be different. Competitive to avoid the arbitrage opportunity asset with the identical payoff structure must have the same price. Valuation options being challenged the task of the pricing. Binomial pricing model is another popular method which use the pricing option. Suppose here, if we look at this example, assume strike price is 100 current market price is 100. At the machine ATM, automated teller machine option, strike price is 100. With the time to the expiry for 1 year, there are two traders, Peter and yes, with who both agree stock price will either rise by 110 or fall by 90 in 1 year. Yes. So the agree on the expected price level in a given time frame for 1 year, but disagree on the profitability of up and down move. So Peter believes the probability of the stock price is going to 110 is a 60% is a probability, yes, chance. What other is saying she believes is 40%. So who's going to be high probability? Which one is a 60 or 40? Which one do you think? 60% is a high, yes, 0.6.
Yes.
And 40 is a low. So based on who would be willing to buy more price for the call option. So Peter is going to be buy, yes?
Mm-hmm.
The Peter is expecting more return. Paula is expecting there are the 40% chance, yes?
Yes.
Possible Peter, as he expected the higher probability of move up. So this is the example is called the strike price. Any question here?
No.
And this model is all about the people perception. Then one of the popular Gordon growth model. Investor use the Gordon growth model to determine the relationship between the valuation and return. Yes, and in certain conditions, the company use the free cash flow, pay dividend regular interval, and the company dividend expected to grow at the constant rate. Dividend mean the return on the shares. If the company will pay more, carry on constant, they will carry on going constant. Performance metrics such as earning also expected to grow same stable rate, and the growth rate is lower than the investor required return. Investor maybe want more, we are giving them less, than sentiments will be low. The Gordon growth model is investor can estimate fair value of the stock, determine whether or not viable to invest. According to appropriate input model, the present the value of the higher than the current price, the stock is considered undervalued. Yes.
Mm-hmm.
And on the other hand, if the model present the value of the lower than the current price, the stock is considered overvalued. Based on this value, investor can make the comparison between the other companies and other industry, one company and another. So this is the formula we have. P represent the present value of the stock. D1 is the value of the next year expected dividend per share in the next year. R is the required rate of return. I want 10%, yes. And G is the growth rate. Yes, how much is growing. So this formula we can use it to calculate our values. Any question here?
No.
Okay. Then the same Gordon growth model being replaced and expanded. Not only look the current, they're saying the base year P is base price, base dividend, and the growth in number of years, and expected return in the number of years, and represent numbers. Yes, I represent 1 is in the formula, all is expected return, maybe in 5-year time, in 10 years time. Yes, we're saying this. Then we have a next model is called international Fisher effect. One is called Fisher's model is quite popular in economics as well. It's called Fisher effect. Is a high inflation. We maybe heard about hyperinflation. If more than 10%, 2-digit, that's called hyperinflation. In economics theory, stating the expected disparity between the exchange rate of two countries is approximately equal difference between their country's nominal interest rate. Yes, nominal is mean the base interest rate in the country, We have in the UK base rate is a 0.01% at the moment. In international Fisher effect states the difference in the nominal interest rate between the country can be used to predict the change in the exchange rate. Yeah. According to IF Fisher, countries a higher nominal interest rate experience higher rate of inflation. If you have a higher interest rate, base rate, let's say we have a 10, in some countries still base rate is a 10%. Yes, we can borrow money here 2%. So they expect high inflation in their country. There is a depreciation, the currency value is going down. So that's also effect on the shares. So in the practice, evidence IF is mixed, and in the recent year, direct estimation, exchange movement is expected. Inflation is more common. As a part of, next we looking the strategy. As a part of performance management, it is agreed the system should be include financial performance. What is a financial? Is a return on money. Non-financial is mean not only the company will grow in the financially, but non-financially, which is we use. I'm not sure you learn about balance scorecard, BSC, which normally we use in F3 as well. So balance scorecard may these reveal the result and action already taken non-financial, and these are the driver for future performance. Okay, do you have a Nokia? Are you using Nokia still?
No,
Why not?
I don't like it.
Don't like it. But we all used to be using Nokia before. Why we not using anymore? Apple is a new company. Samsung is a new. Nokia is old, yeah? Because the Nokia focus more on they cut the cost, research and development centers, and just one second. Okay, sorry about that. Okay, so we have financial perspective. So the CEO of the company cut and close many research and development center in the world, and ultimately they not manage to launch a new mobile phone. Yes, so they not focus on the innovation and learning. They more focus on the cost. Yes, some people say why I'll give tuition and why I pay fees to learn this. Yes, then of course in future they can't learn it because they don't have a learning, they don't have innovation. Yes, because we call in money spending in education is an investment. Yes, and we can get the future return. So it's the same happened with the Nokia, and that's why Nokia stayed behind, and the CEO of the company left the company and said sorry. Customer perspective, customer want good customer service. Internal business, we want to be excel. Vision and the strategy of the company, we want to lead and exceed, like now is Apple. So that's we'll carry on. Within the research perspective, business should seek to identify the serial goal. These are the critical, and we can measure the key performance KPI, key performance indicator. So we can go through this next slide. You will see what is a customer perspective. Customer want low cost. Yes, cheaper product, high quality, good customer service. And we want to compare with the industry benchmark. Internal perspective, worker want to be learned, production cycle time and all. Innovation, employees want satisfaction, innovation, new technology, new learning, training and development. Financial perspective, we want profit, we want survival, we want more return on capital. So these are the and for these to achieve, we want to be developed strategies. We want to choose the measures, we define and refine, and we select the right people. And ultimately, what we need to do, we need a good management system in place. Yes, what we said earlier, management need to design an environment. We use good IT system, and ultimately all these will help to maximize our return. Any questions? Okay, this is all about, today we learn about how many theories we discuss. Can we name theories? How many theories we discuss? Or maybe we can name one or two. Prospect, yes. Yes, prospect, Gordon, arbitrage. Yes, these, the theories we discuss. At least, 2, 3 we can keep them name in a head. Then we discuss about BCS, which is called balance scorecard. We learn about customer perspective, innovation perspective. Yes, and learning perspective. So these all 4, 5 perspective we discuss, and we need a balance between them. Not spend too much money on one side. You need a balance approach. Any question? Hello? Yes, that's all, So today, guys, we learn about. Okay, so, okay, that's all today. If you have any question, you can ask, please. Hello, can you hear me?
Yeah.
Any question we have from today lesson?
No, it's good.
Okay, so please, these slides will be available on Moodle, so you can read. Yes, we'll send you. If you have any question, feel free to drop me email, and hope so I'll speak you during our next lesson.
Okay.
Nice to speak to you. Thank you. Thanks for attending. Have a lovely evening.
Thank you.
Thank you.